Welcome to This Explainer. Today, we're going to completely demystify the invisible forces that are literally shaping your wallet and the entire global economy. Have you ever actually stopped to think about what happens to your paycheck the absolute second it hits your account? We interact with banks every single day, right? Yet the underlying architecture of modern money is kind of a complete mystery to most of us. So today, we're peeling back the curtain and looking right inside the global money machine. Okay, let's kick things off by challenging a core assumption you probably have about your own bank account. Seriously, where is your money right now? Most of us picture this highly secure digital vault where our cash just sitting patiently, waiting for us to swipe our debit card. Well, the surprising truth is that banks do not just hold your cash for safekeeping. No, they use it as raw material. When you hand over your hard-earned cash, you're actually making an unsecured loan to the bank. Think about that. The exact moment you make a deposit, the bank records a liability, meaning they owe you that money on demand. But they also record an asset. They take your cash and they put it to work immediately. And this right here is the magic of fractional reserve banking. It's how your single deposit is multiplied to literally create new money out of thin air. Imagine you deposit $1,000. The bank holds onto a fraction of it, say 10%, in their reserve. Then they lend out the remaining $900 to somebody else who's maybe buying a car or starting a small business. That $900 gets paid to a seller, who then goes and deposits it into another bank. And the whole cycle starts all over again. It's a bit counterintuitive for sure, but it's a fundamental economic truth. Commercial banks create the vast majority of money in our economy simply by making loans. Now, let's see how this builds from your personal checking account into a massive worldwide network. Section 1, the global money plumbing. Picture this, like a massive tiered highway system. Up at the very top, you've got the Federal Reserve or the European Central Bank pulling the big levers. And then your local retail bank operates down at the base. At that apex, central banks issue the nation's ultimate money, and they set the interest rates that dictate what borrowing costs for everybody else. They're essentially the bankers' banks. Down at the base, commercial banks handle all the day-to-day stuff with you and me. And with businesses, they hold their own accounts at the central bank, using that base money to settle transactions between themselves. So what happens when that money has to actually cross a border? When you send money internationally, it doesn't just teleport. It flows through a highly complex, highly concentrated pipeline of what we call correspondent banks, all chatting with each other via the SWIFT messaging network. Let's say a small bank in Ghana wants to send funds to Japan. They probably don't have a direct link. Instead, they route that transaction through a massive correspondent bank. Think Citibank or Standard Chartered. That huge bank then uses the SWIFT system to securely ping the transfer before it finally settles in Japan. It's this intricate, multi-step handshake happening literally millions of times every single day. But you know, what happens when the pressure in this massive global engine gets way too high and the pipes burst? That brings us to when the system breaks. To really grasp modern systemic risk, we've got to talk about shadow banks. We're talking about hedge funds, private credit firms, money market funds, places that do exactly what banks do, but without the heavy regulatory safety nets. Today, traditional, heavily regulated banks still hold over 81% of loans. But these shadow banks, they now hold over 61% of all debt securities. Because they're operating outside direct banking regulations, they can grow incredibly fast. But the catch is, they introduce immense and honestly sometimes totally opaque risks into the system. Risks that could absolutely trickle down and impact everything from whether a company is hiring, right down to your personal retirement account. And if history shows us anything, it's that financial instability is a constant. It's not just a modern anomaly. Each era faces its own unique triggers for a panic. Whether we're talking about the catastrophic failure of thousands of banks back in 1929, the whole meltdown of complex mortgage-backed securities in 2008, or even the sudden tech-fueled regional bank runs we saw in 2023. The fundamental vulnerability is almost always the same, a terrifying mismatch between liquid liabilities, which is depositors wanting their cash right this absolute second, and illiquid assets, which is money tied up in loans that won't be paid back for maybe decades. To put that into perspective, just consider the sheer scale of a modern bank run. $42 billion. That is the staggering, almost unbelievable amount withdrawn from Silicon Valley Bank in a single day back in 2023. Driven by a highly connected depositor base, chatting on social media, and just tapping buttons on their mobile apps, it proved that in the digital age, a bank run can happen literally at the speed of a fiber optic cable. Which leads us to a pretty terrifying reality. Some of these institutions are just so massive The government effectively has to act as their ultimate insurance policy. When a bank becomes quote-unquote too big to fail, letting it collapse would freeze that entire payment plumbing we were just talking about. And this creates a classic moral hazard. If these huge institutions know they're ultimately going to be bailed out to prevent a systemic collapse, well, they might just be incentivized to take on way riskier, highly profitable ventures. So we're currently seeing a really fascinating regulatory divergence as a response. On the international stage, you have the Basel III standards pushing to mandate thicker financial cushions so banks can absorb their own losses. Conversely, you have recent US proposals aiming to actually reduce bank capital requirements with the goal of lowering funding costs and boosting lending. It's a very complex tug of war between maintaining systemic safety and driving economic growth. And that tension bleeds right into the politicization of ESG, environmental, social, and governance criteria. Financial institutions are totally caught in the middle right now. They're facing pressure from some groups to integrate climate risk into their lending, while simultaneously navigating certain US states that are restricting business with firms they consider to be boycotting fossil fuels. Because of this push and pull, we're actively seeing major banks withdraw from various climate alliances just to navigate these conflicting political and business realities.
Okay, let's pivot to the bleeding-edge technological frontier that is completely rebuilding this entire machine as we head toward 2030, the future of finance.
Listen, AI in banking, it is absolutely not a gimmick anymore. It's already deeply integrated into everything from approving your mortgage using non-traditional data to blocking a fraudulent transaction in literal milliseconds. The banking models of tomorrow are relying heavily on machine learning to process hundreds of variables and predict creditworthiness with just incredible accuracy. Generative AI and intelligent algorithms are shifting the entire profit pool of the banking industry as we speak. It's a real game changer.
But maybe the most profound shift happening with national money right now is the rise of the CBDC, or central bank digital currency. This is a digital asset that carries the exact same safety as physical cash, but obviously comes with some pretty complex privacy implications. See, unlike the balance on your banking app, which is really just a claim on a commercial bank, a CBDC is a direct liability of the government itself. It is true digital cash. But because it's completely programmable and totally traceable, it raises some really profound questions about financial surveillance and our data privacy. Globally speaking, we've got 146 countries exploring CBDCs right now. China's digital yuan is aggressively leading the pack, already processing the vast majority of cross-border settlements in major pilot programs. Meanwhile, you look at the US, and a 2025 executive order actually banned the Federal Reserve from establishing a CBDC. This massive contrast really highlights a major shift in how the world's largest economies are approaching the entire digital future of their sovereign money. But hold on, because the ultimate disruptor goes way beyond just digital currency. Enter agentic AI. We're moving from AI that just gives you friendly advice to AI that actually takes action for you. Imagine a system that constantly, relentlessly scans the entire global banking network, and it automatically moves your savings to wherever the yield is highest, down to the absolute millisecond, with absolutely no human input required. Which leaves us with one final, pretty provocative thought to take away from this explainer. Humanity built this incredibly complex, beautifully intricate financial engine. But are we truly prepared to just let the machines drive it? As we transition away from human ledgers and brick-and-mortar vaults toward autonomous AI agents and purely digital central bank money, the very definition of what a bank is changing forever. Thanks so much for joining me on this deep dive into the anatomy of the money machine. Keep questioning, keep learning, and I'll see you in the next explainer.